Everyone, today we are going to discuss a new topic from the chapter Accounting for Partnership Basic Concepts. Today's topic is Guarantee of Minimum Profits to a Partner. So first of all, let's understand the meaning of word guarantee. Guarantee means surety of a particular amount of profits by one or more partners. In guarantee of profits, a particular partner is assured that his share in profits will not be less than a particular amount. In other words, it is a minimum fixed amount for the partner who is given such a guarantee that he will be given this very amount of profits. If the actual share of profits is less than the guaranteed amount, then the difference between the actual share of profits and guaranteed amount of profits is known as deficiency, and that deficiency can be either borne by one partner or it can be borne jointly by more partners. Next, the important rule regarding guarantee of profits to a partner. If nothing is mentioned in the question about who will bear the deficiency, in that case, the deficiency will be borne by the remaining partners in their remaining ratio itself. For example, X, Y, and Z are three partners and their ratio is 3:2:2. Z was given a guarantee of minimum profits of rupees 1 lakh. In this case, if there is any kind of deficiency for Z, then it will be borne by X and Y in their ratio itself, that is 3:2, because Z will be given the guarantee and its deficiency, if any, will be borne by X and Y in the ratio of 3:2. The next question is, how do we calculate deficiency? Deficiency is calculated as guaranteed share of profits minus actual share of profits. Next, we are going to discuss various cases of guarantee. The first case of guarantee is when actual share of profits is more than the guaranteed share. In this case, there is no deficiency and nothing is to be given to the partner who is given such guarantee, because his actual share is already more than the guaranteed share of profits. Then we discuss case number 2, when actual share is less than the guaranteed share. So here the difference between the actual share and the guaranteed share will be termed as deficiency, and this deficiency will be borne by the partners as decided by them. This deficiency may be borne by any one partner or it can be borne by more than one partner in a particular ratio as given in the question, or sometimes if nothing is mentioned how that deficiency will be borne by the other partners, so in that case deficiency will be borne by the remaining partners in their ratio itself. Now let's discuss a question for the same. Ram, Shyam and Gopal are partners sharing profits and losses in the ratio of 2:1. Gopal was given a guarantee of minimum profits of rupees 30,000. Any deficiency in that account shall be met by the other partners. Now in this question, it has not been told how the other partners are going to bear that deficiency, so we write as Ram, Shyam and Gopal. Gopal is given the guarantee for minimum profits, then if nothing is mentioned in question, it will be borne by the other partners, that is Ram and Shyam, in the ratio of 2:2, which will be also written as 1:1. The net profit earned by the firm for the year ended 31st March 2020 amounted to rupees 2 lakh. Show the distribution of profits. So if we see what are the total amount of profits, it is 2 lakh rupees. Guaranteed given to Gopal is 30,000 and ratio of Ram, Shyam and Gopal is 2:1. So let's see its working first. Profit sharing ratio between Ram, Shyam and Gopal is 2:1. And Gopal's guarantee is 30,000 rupees. Now, first of all, we will calculate what is the actual amount of profits available for each partner. So, we'll see net profits available for distribution. These are rupees 2 lakh. This 2 lakh will be divided amongst all the partners, that is Ram, Shyam and Gopal, in the ratio of 2:1. So accordingly, Ram's share of profits will be 2 lakh into 2/5, which will be equal to rupees 80,000. Then Shyam's share of profits, again it is 2 lakh into 2/5. Again it will be rupees 80,000. And Gopal's share of profits, if we calculate it also, then Gopal's share of profits is also equal to 2 lakh into 1/5, and it is rupees 40,000. Now we have to compare what is Gopal's actual share of profits. If we see it, Gopal's actual share of profits, it is 40,000 rupees. And what is Gopal's guarantee? It is 30,000 rupees. So here Gopal's actual share of profits is higher than the guaranteed profits. So there is no deficiency in this case, and nothing is to be given extra to Gopal. And however, we will transfer rupees 40,000 to Gopal. We can show it with the help of a profit and loss appropriation account by net profits brought down 2 lakh rupees, and the profits have been distributed amongst Ram, Shyam and Gopal as 80,000, 80,000 and 40,000. So profits transferred to Ram, Shyam and Gopal are 80,000, 80,000 and 40,000. Then we will do total on both the sides. So this is how we will do a particular question of guarantee of profits to a partner. Now let's discuss another question. Question number 2. The question is A, B and C are partners sharing profits in the ratio of 5:3:4. B was given a guarantee of minimum profits of rupees 60,000 in any year, and the deficiency, if any, shall be met by A personally. So here very clearly it has been told in the question that if any deficiency arises in this case, then that deficiency has to be borne by A. The net profit earned by the firm for the year ended 31st March 2019 amounted to rupees 1,80,000. Show the distribution of profits. So here we have to note down three things. Net profits 1,80,000, profit sharing ratio 5:3:4, and who is given the guarantee? It is the B who is given the guarantee. So we'll do its working. Net profits are rupees 1,80,000. Profit sharing ratio between A, B and C is 5, 3 and 4. Then who is given this guarantee? The guarantee has been given to B, that he will get at least rupees 60,000 as share of profits. Fine. So first of all, we will have to find out how these net profits will be distributed between A, B and C in the first instance. So let's see its working. I have prepared a working note for the same. We have taken three partners A, B, C. The profit sharing ratio is 5:3:4 and the total profits are 1,80,000. So first of all, we will distribute these 1,80,000 amongst A, B and C in the ratio of 5, 3, 4. So the actual share of profits accordingly 1,80,000 into 5 by 12. It will be 75,000 rupees. Then we will find out actual share of B 1,80,000 into 3 by 12. It will be rupees 45,000. Then we will see actual share of profits of C. It is 1,80,000 into 4 by 12. So C's share will be 60,000. Fine. Now if we see share of profits of B is 45,000 and B has been given a guarantee of rupees 60,000. We'll see B's guarantee 60,000 less B's share of actual profits. It is 45,000 as we calculated in the working note. So in this question we come to know that B's share of profits is less than the guaranteed amount. So here is a deficiency of rupees 15,000. And as told in the question, this deficiency has to be met or borne personally by A. So it is only A who will bear this deficiency. So we are going to deduct this 15,000 deficiency from the share of A and we are going to give this amount to B. So we'll deduct it from A and give it to B. Then final profit share will be A 75,000 minus 15,000. A's final share will be 60,000. B's final share will also be 60,000, that is 45,000 plus 15,000. C's final share of profit is same as before, that is 60,000. So this is how we are going to distribute the net profits to all the partners after considering guarantee. Then we have to prepare profit and loss appropriation account for it. In profit and loss appropriation account, first of all we will brought down the net profits on credit side by net profits brought down 1,80,000. Then we will divide these net profits amongst A, B and C after considering the guarantees amount. That is, we will transfer this final share of profits to A, B and C. So we will write it to net profits transferred to A, B and C. So we'll take the amount from the working note. A's share is 60,000, B's share is also 60,000, C's share is also 60,000. So this is how we are going to complete the question of guarantee of profits to a particular partner. Now we move to the next question, that is question number 3. The question is X, Y and Z are partners sharing profits in the ratio of 3:1. Z was given a guarantee of the minimum profits of rupees 20,000 and any deficiency arisen in that account shall be met by X and Y in the ratio of 5:4. So here we are given a specific ratio that is to be used for covering up the deficiency, which means if there is any deficiency then that will be borne by both X and Y in the ratio of 5:4. The net profits earned by the firm for the year ended 31st March 2020 amounted to rupees 1,03,800. Show the distribution of profits. So here we have to notice two things. Number one is net profits available with us are 1,03,800. Then profit sharing ratio is 3:1. But if there is any deficiency, then the deficiency will be covered up by X and Y in 5:4. So let's start doing it. First of all, we'll write net profits. Net profits available with the firm are 1,03,800. Then profit sharing ratio between X, Y and Z is 3, 2 and 1. After that we have to consider what is the guarantee. Z is given the guarantee. Z's guaranteed profits are rupees 20,000. Now we'll find out whether there is any deficiency or not. For that, first of all, we have to find out share of profits of X, Y and Z. So we see it. X share of profits 1,03,800 into 3 by 6. Y's share of profits 1,03,800 into 2 by 6. Z's share of profits 1,03,800 into 1 by 6. So if we calculate, X share of profits will be 51,900, Y's share of profits will be 34,600 and Z's share of profits will be rupees 17,300. Now if we compare Z's guaranteed profits, that is rupees 20,000, and Z's actual share of profits, that is 17,300, we'll see here is a deficiency. So Z's guaranteed profits, we will deduct Z's actual share of profits from it. Z's actual share of profits is 17,300. Now we calculate. We can see very clearly here is a deficiency of rupees 2,700, and this deficiency has to be borne by X and Y in the ratio of 5:4. It means X will bear the deficiency 2,700 into 5 by 9 and Y will bear the deficiency 2,700 into 4 by 9. Now if we see it, it is 1,500 deficiency to be borne by X and 1,200 as deficiency which will be borne by Y. So let's see it in the form of the solution. First of all, we'll write the working note. We have three partners X, Y and Z. The ratio is 3:1. Just now we calculated actual share of profits. These ones 51,900, 34,600 and for Z it is 17,300. Then we found out the amount of deficiency also, that is 2,700, and that deficiency will be covered up by X and Y in the ratio of 5:4. That is, will cover rupees 1,500 from X and 1,200 from Y. So I am going to adjust the deficiency. I am going to take 1,500 from X, 1,200 from Y, and I am going to give this amount of total 2,700 to Z, so that Z gets his guaranteed amount of profits equal to 20,000. So Z got total share of profits as rupees 20,000. Now we will find out X and Y's share also. X final share of profits is 51,900 minus 1,500, that is 50,400, and for Z it is 34,600 minus 1,200, that is 33,400. So these are the final share of profits which we are going to put in profit and loss appropriation account. So let's prepare profit and loss appropriation account. By net profits brought down 1,03,800. Then we will transfer these net profits to all the partners X, Y and Z with their final share. To net profits transferred to all partners capital account, that is X, Y and Z. We will take their final share 50,400, 33,400 and 20,000. In the last we will write the totals also. So this is how you are going to solve the questions of guarantee of profits to a particular partner. I hope all of you might have understood the topic. Thank you and have a nice day.